Now, most of you have heard about the term smart money concept, right? And you may be asking, well, what is that really? Well, it all depends, because in reference to the style and how I trade, surrounding supply and demand, we're talking about aggressive areas of buying and selling where the market has moved away and has created a supply zone or a demand zone, okay? That is where the institutions, the banks, where smart money is injecting fuel, okay, or money into the market to make things happen, all right, where the market's breaking structure constantly to the upside, trending in one direction, making higher highs and higher lows, or we're reversing and then we start to make lower lows and lower highs, breaking structure in the opposite direction. It's just swift movements within the market that they're making with this aggressive buying or selling. When you see the market making big moves, say for example, like right here where you got a lot of buying to the upside, well, that's the institutions, the banks. They are looking to place buy orders or positions in the market where they push the market fairly quick from a nice area of demand, okay? Or it could be where, they are setting up and you have a nice aggressive selling to the downside. When you see these big, large candles or candles coming swiftly to the downside or upside, those are the institutions or banks. That's called smart money concepts or smart money movement within the markets, okay? And you'll see that regardless of what market you trade. Now, today, what I want to share with you, and we're going to go over an example of the simple strategy and how I bring things into the fold. But I want to talk about the 5% rule because that's very important. Maybe asking, what is that? The 5% rule is where, no matter how much money you actually have to trade with, the capital, whether it's $1,000, $10,000, 20, 50, 50,000 or 100,000, you want to keep your risk basically the same. Okay, so if I'm starting off with a $500 account, 5% of that is only $25, right? So you're probably asking, well, that's not a lot of money that well, it's only 25% what you're actually risking, and you're looking to basically double that. So if you're risking 25, that means you're not wanting to get stopped out on more than $25. You're looking to at least make $50 on a day. Well, you're probably saying, well, that's not a lot of money. Well, if you're part-time and you're just starting off, or you're a beginner that has a small account and you're looking to grow it, this is an excellent way to do so. And not just once you start off trying to grow a small account, but down the road, each time that as your account starts to compound on a monthly basis, keep the 5% rule consistent, and that's going to keep you into profitability because you have a set amount in which you're looking to actually profit. Okay, risk versus how much you're looking to profit. So if I'm looking to profit, risk $25, I'm looking to profit $50, right? If I'm looking to risk $50, then I'm looking to profit $100, right? So doubling up on each time. Now we're going to look at and take the first $500 that you may have, right? On a 5% rule, that's $25 that you'll be risking. So that's where you replace your stop at. No more than $25, okay? Trading the micros, I say this for all beginners, is where you really need to start at. If you're interested in growing, whether it's a Nasdaq small account, a S&P 500 small account like the ES, or maybe you're trading some of the other commodity markets. But I want to stick with the Nasdaq, the MNQ, small accounts today. Let's talk about that. So with a small account in the amount of only $500, and you're risking just say $25, okay, which is 5% of that account, then your stop should be no more than at 12.5 points, wherever you're looking to get into a trade at. So 12.5 points is your thresh. That's the total amount in which you are looking to take a stop on, right? So you're looking to double that in terms of size when it comes to profiting. So if I'm wanting to take have a stop of 12.5 points, I'm looking to, have a profit of at least 25 points. That's simply going for a 2-to-1 pretty much. I'm risking, 5%, which is $25, and looking to double that to make, that $50, right? Which is going to be pretty much $250 at the end of the week. It's not a lot of money, but it does add up at the end of the month. Then that's going to take you from where you started at of $500, and now you're going to be at what, $1,500. Or you can simply go on for a 1-to-1. That's simply, for someone that's looking to only risk 12.5 points to basically risking $25, and you're looking for a 12.5 point movement. That's a 1-to-1 to make $25, right? You could do that just as well to make $25. So you're risking a 1-to-1, risking 25 to make 25, or you can do that in one trade. Or the next thing you can do is take another setup. If you do that same thing, you're looking to, let's say you're looking to make a 25 points on a day. 12.5 the first trade, 12.5 the second trade. That's going to give you 25 points. That's going to give you $50 on the day. Trading the micros now, you could do that. Now, again, that adds up to be, if you're looking to do a 2-to-1, 250 a week, which is $1,000 at the end of the month. That's month one. And then from there, it really starts to compound. If you move into the next month, doing the same thing to where you are using the 5% rule. So the first month if you're doing the 2-to-1, where you're looking to either take a one shot, one and done, meaning risking 12.5 to make 25 points, that's going to get you at $50. Or you can split it up, do two simple trades to where you're risking 12.5 points to make 12.5, and do that twice to get you $50 on the day. Okay. Now into the second month, all right, that's when things really start to grow, because now you can, or start to roll, because now you're moving away from, keeping things simple, 5%. Same thing, and you're making 250 a week in the first month. Again, in the second month, then you roll from 250 a week to 750 a week. And you say, well, how can I do that? Well, now because you have a larger size account, you can bump up the number of contracts in which you're trading. Instead of just trading one contract like you were in month one, now you can bump up to say 3 contracts, and now that's going to put you at $750 a week. Times 4, that's going to be $3,000 a month. You could do that simply by using the 5% rule and sticking to that. Okay. All right. So it's like making 5%, having a 5% risk tolerance and 10% gain. Right. You're basically doubling what you're actually looking to actually risk. All right. So if you're starting off with $500, $25 is going to be your thresh, which is 12.5 points, and we're looking to double that 2-to-1 to make $50. Let me show you a great way in which you can, do this. All right, I've kind of talked about the math prior to, and then each month, as you are continuously and consistently profiting, then you can start like bumping your contract size up. Basically, going 3 times over each month. So the first month, 1 contract, second month, now you can move it to 3 contracts, and, then into the third month, you can really bump it up and start trading really probably, 5 or 6 contracts, micros now we're talking about. I would do it that way until you can consistently start building up an account higher and higher and higher. But just going from month 1, and make it and turning that $500 into $1,000. Now you got $1,500 month 2. Now you're at $1,500, and now you done made $3,000. Now you have a $4,500 account at the end of month 2. That can actually happen if you are consistently profiting each and every day, just scalping for those amount of points each day. So if we look at a quick calculator right quick, I'm just going to show you. So the first month, 250 a week, times 4, that's, roughly going to be like $1,000 plus the $500 that you started with. Capital wise, that's going to be $1,500 a month. So the next month, let's say second month, $1,500 in total. And then you have, you risking, 5%, right? 5% of that, that's $75. So that's my risk tolerance, right? So if I'm going for 2-to-1, then I'm saying I'm going to risk $75 to make $100, right? $150. So $150 times, let's say, 5 days a week, if you're able to do that, $750 times 4, that's $3,000. So into month 2, where you started with $1,500, now you're able to gross, say, $3,000 plus the 15 you have. So now going into month 3, you would have $4,500. That makes sense. The ball starts rolling from there. Okay, it really does. Basically after month 2, which is 60 days. If you don't believe me, you could try it, but you're going to, really be needing to only take 1 or 2 setups a day in scalping. Don't get in and start trading or over trading or revenge trading and say, oh, I lost on the first trade, let me go in for a second trade. Look, if you lose your first trade, just cut it. Call it quits for the day, look to set up shop the next day and do it again, okay? Don't keep doing it, because if you get into that second trade, and I'm just saying this, I'm not telling anyone what to do with their capital or their funding, but the more you start trading and taking trades, at some point, that's when you're really going to start blowing your account. Now with a small account, again, we're talking about smart money concepts where the market is either moved drastically away swiftly from either a demand or supply area. Supply and demand is what I'm talking about. Pulling back and retracing to a beautiful area of aggressive selling and buying. Now, when it comes to the Nasdaq futures, again, this is the Emini version. Okay, we're talking about the micro Emini. This is what I have up currently. It's the same thing. Just look at this chart as if it was just the MNQ, micro Nasdaq. So what I'll be looking for is, first and foremost, is I'm looking for a direction of the market. Okay, that's very important. So like right here, this was a bullish market to the upside right here, and then the market came back and pulled back right here on May 13th. But this is a valid demand zone. Maybe asking why? Well, we got aggressive buying here. The market didn't come back to this zone. More aggressive buying with broke structure to the upside, and that's one thing that I must have is a breaker structure when it comes to, and I like to identify when it comes to trading demand zones. So we have the aggressive buying here. That's the the institutions, the banks, and then the market retraces back to the zone. So let's go down to the May 13th right quick on the lower time frame chart. The way I trade is I like to mark up a higher base zone first off a higher time frame chart, and that is my 120. Now maybe you trade a different type of chart, style chart, maybe like a time base, volume, tick, whatever it may be. Time and range charts are not comparable because they are calculated differently. Time is based on time calculations. When the as far as every 5 minutes, 15 minutes, bar open and bar closure. Range is more so calculated based on the amount of momentum and volume coming into the market. That's going to determine how swiftly a candle open and closes. So May 13th, what time was this? This was at 2:05. Okay, let's go to it right here. So this is the larger zone off of my higher time frame 120. So I mark it up first. Okay, what I'm looking for is confluence or enough confluence to get me or allow me to take the trade. So this was the aggressive buying to the upside right here that we saw on the 120. As the market approaches back to the actual demand zone on the 120, the larger time frame chart, then I'm starting to look at lower time frame charts. Say you could do it on the 60 or the 24. The more confluence you have across charts, that's just going to give you more confluence to want to get into the trade because the market's more so going to react and reject at that area. Now let's go down to the 60. There's also a demand zone resting right here. Aggressive buying to the upside. The market comes back to the zone. This is the red box or the red outline rectangle is the 60 range demand zone. Let's move down, scale down one more chart. Move down to the 24 range. Here it is right here, the yellow outline box. That's the 24. So I'm looking for the first higher time frame, the second higher time frame, and then the entry point to where I can get to the trade. 3 charts giving me confluence here. That's enough for me to want to go long. I get into a trade right here off the rejection of the 24 range demand zone. All of these are high probability setups. If you don't quite understand what I mean or able to, what's the difference between a low probability and a high probability zone, go back to the home page and use a little search tool on the home page. Type in imbalance or gaps because that's what it is. We're looking for imbalance or gaps resting back at the zone. That's either going to market or make it high probability versus low probability. And there's a nice imbalance resting right back at the actual zone. Okay, so as the market comes back, taps the 120, 60, and then the 24. 3 means of confluence here. I'm definitely looking to go long if we get the rejection to the upside. Now, again, like I said, $500 account. You could go for the 12.5 points, 12.5 points risk and 12.5 point profit. Again, that's only going to give you $25. Or you could take 2 trades and that's going to give you 50. Now, you could go for full in and try to pick up the 25 on the first trade and be done. That means pick up your first $50 on where you're only risking 25. So that means you're having a 12.5 point stop with a 25 point profit. Okay, that's your 2-to-1 right there. Make 50 on the one trade, close it, be done, and do it again the next day. If you could do that consistently each and every month, then you're moving up the ladder to where now you're making $250 a week. Do that solid for a month. Again, now you're going to hit the $1,500 mark, and then that's where things really start rolling from there because now you're able to bump up a few contracts to start trading and making more money. So again, like I said, month 2, $75 will be the risk. 150 is what you'll be looking for profit. Now let's go to another trade example right quick. I'm trying to wait for here we go. Let's go to Friday. There was a nice demand setup. Right here, the market was moving sideways. It was bullish, as you can see right here to the upside. And then it made a low, it made a lower high here. We didn't break this area of structure here. We started moving sideways in between the overall direction of the market. Okay, so we're still bullish right now. We really haven't reversed coming to the downside. So that's why I have this line here and this line here. This is a wedge setting up. Had it broke below this, continue pushing and make a lower lows and broke below this low here, then, and the market came down and break here, then we would have had a reversal of the market. But the market came down here, tested this low, then it started making highs, higher lows, highs, more highs, higher lows to the upside, and it broke above this area structure right here. Now, this is aggressive buying that's done by the institutions, the bank, smart money. And then the market pulls back to this key area. This is an aggressive area where there's an imbalance resting on the higher time frame 120 range zone. You can do this again on your 60-minute chart or your 5-minute chart, but you always want to start with your higher time frame. So if you using time-based charts, then mark up your 60-minute chart and then look to scale down on your 5-minute chart. Or possibly even a 1-minute chart. You can go from the 60 to 5 and a 1 if that's what you trade time based. For me, I'm scaling down from the 120 down to my 24 range chart. So if I move down to the 24 range, I'm going to show you right quick. The larger box right here, that was the demand zone from the 120. Okay, right here. Now, if I move down to the 24, you can see we have a beautiful area of demand resting on the inside, and it's high probability because we have an imbalance, a gap, where this candle here didn't come back to close the gap back down to the zone. I'm looking for, once the market taps the rectangle blue box into the 24 range zone, reacts off of it, go long. Again, stop loss goes back 12.5 points. That's your risk. Okay, that's what you're saying. That's the max, the largest amount that I'm looking to actually risk this on this trade here is 12.5 points. Now you're either going to go for 1-to-1 to pick up the $25 at 12.5 points, or go for a 2-to-1 to where you can have a 12.5 point stop. Okay, $25, and then looking to make 25 points to pick up your 50 points. I mean, excuse me, your $50. Okay. This is trading again the MNQ, the micro Nasdaq. All right. So I want to show you the 5% rule. If you stick with that, then each and every month and carry it through, then your account, you can grow a small account and move from there and start capitalizing more on and profit or more money as your account size grows. And that way, when you start doing that, then you can start to bump up your contract size, or simply put, you can switch over from the micros over fully to the Emini Nasdaq, which is the NQ. Okay, some people prefer just to go ahead and stick with the micros and just bump the contract size. Some people like to move over to the E-minis and just start off again trading with one E-mini contract and then working it up from there. Okay, just depends, but the 5% rule works for growing a small account. All right, so I want to share that with you guys today. Anyone out there, because I know a lot of people have been asking me about how they can become an Ultra Elite member. The link is down in the description portion of the video. The first link is for the Discord, which is free to join. The Ultra Elite membership is the second link below that. If you click on it, 3 tiers are going to pop up. Make sure to choose the second one. The third one, which is the Ultra Elite membership. Now, there is also the Elite tier. The difference between just the basic Elite and the Ultra Elite, with the basic Elite, you get the trade breakdowns, the video playlists, and the market structure video, okay, and any other like small little video clips or content that I post for that tier. Now, with the Ultra Elite, you get everything inclusive of the first 2 tiers. Plus, you also get the live trading or live recorded trading session and the market recap. So you're getting a lot more. You get the live recorded trading sessions, the market recaps, the trade breakdowns, the video playlist, and the great video that I covered surrounding market structure. All right. So you get all that for what you see for that price there, which is just pennies on the dollar a day. Trust me, it's well worth it, but I'm not going to force anyone's hand. You have to try it out for yourself and see if it works, or come over to the Discord, ask people, how has the membership or helped them out in terms of the trading, and is it worth? You can ask members that, okay? I'll let them speak for themselves, okay? But outside of that, I appreciate everyone tuning in and watching the videos. Again, the links are down below. If you aren't a current subscriber, please take the time to go ahead and sub by clicking on the subscribe button. Make sure to turn your post notifications on so you do not miss any of the uploaded content. And last but not least, if you found value in today's video, okay, it's Sunday. We got a new week ahead of us. If you found value in this video today, okay, talking about the 5% rule, I would highly recommend you trying to work it out and see if that's going to work for you. Maybe make it part of your trading plan. Give it a test. See if you can build up your capital. Build up capital that way, or your small account up that way. Give it a try. But outside of that, if you found value, please make sure to click that like button. I'll see everyone in the Discord starting tomorrow. Take care.